Ladies and gentlemen, to kickstart this event, the first speaker it will be Mr. Chan Ken Yew. He is the head of research of Kenanga Investment Bank. He is the chief strategy of Kenanga Research, analyze the overall equity market direction and the microeconomic condition. Prior to his current work, Mr. Chan was a head of research of MIMB Investment Bank. He was also a vice president in OSK Ventures International Bhd. In 2009, he acted as a director of the eBworx and MNC Virus Bhd on behalf of OSKVI. In more than 10 years experience in the equity market, he has received a handful of awards. To name a few, he was rated as the second best property analyst by the Age Malaysia in year 2004. In 2009, Financial Times and StarMine ranked him as the top 3 banking analyst in Pan Asia. During the same year, he was also awarded as the top 10 overall stock pick in Asia as well. Moreover, Mr. Chan held a Master of Finance from the RMIT University, Australia. He had also obtained a Bachelor of Property Management from University of Malaya. Let us invite Mr. Chan Ken Yew to brief us about the 2017 Malaysia market outlook.
Morning. Thank you, Ms. Wong. Thanks for the kind introduction. Good morning, everybody. I know it's a Saturday morning. Try to go in a quite light mode. And as usual, I like to start my presentation just to give you some macro background, give you some the idea of where is our top flow before we go into the stocks and the sectors we are looking at, especially for the second quarter. Now, very briefly, in terms of economy side, we still think that the growth is still quite decent, about 4.5% this year, mainly driven from the manufacturing side. That actually boosted by a healthy or the better export demand, as well as the service sector. These are the two main, I would say, the contributor to our GDP. Apart from that, I think private consumption or the private expenditure also will help to actually boost the GDP further. Now, in terms of interest rate outlook, probably I think we still hold our view that interest rate will remain unchanged, even though I think Fed recently just hiked their benchmark discount rate by about 25 basis points. And the market actually expect another 2 more hikes in later of the year. Even with that, I think because of the growth, I would say the growth agenda, probably I think for domestic side, probably the rate, probably the hike will actually, even let's say if we increase also, I think the pace will definitely slower compared with the US. For ringgit, our forecast for the year, for second half especially, is about 440 to 460. It's quite a big range because we think it's still volatile in view of the uncertainty over the US interest rate monetary direction, and also I think the uncertainty in the Europe side. As you know, I think Europe country, some of them I think France and France, I think especially I think in the middle of the year they're going to have their own elections. By year end, we hope that ringgit will strengthen. We're actually looking at about 430 to 5 by year end. In terms of deficit target, definitely I think the target of the government of 3.1% I think is achievable. Even though I think a lot investors actually concerned because the forthcoming general elections, probably government need to loosen their budget. It means they have to increase their OPEX and also their CAPEX in the development expenditure, all those things. But again, I think with the better or the higher GST collection, I think that 3.1% budget deficit is pretty achievable. So For the Malaysia economy, I think for the short term, definitely, I think the risk is on more on the US rate hike. The China side is more on the rising debt risk, and of course, I think the oil fluctuations. Also, I think the European elections in general, and also I think, of course, the ongoing issues. I mean, the higher household debt, all those things, all those stuff. Medium to long term, of course, I think the US the economy policy, especially under the new president, that definitely will have, I would say, the more uncertainty to a longer term impact. And of course, I think the GE will also be one of the so-called, it can be a positive and can be I would say, the uncertainty to the market as well. Okay, in terms of market, what have actually changed since last year? Now, if you look at the CI, we actually performed quite decently. I think we year-to-date CI up about 6.5%. If you compare with the regional indexes, I think they also performed quite well. I think on average they did about 5.1%. Also, I think of late we saw the foreign flow start to actually flow back to this region, including Malaysia. As you can see from the chart, I think that the last two months here, the foreign net buying position actually spiked up quite strongly. In fact, I think year to date we saw about 3.5 billion net inflow back to the market. Last year, the fourth quarter itself, we saw about 5.3 billion net outflow. So far, we actually record more than half of the outflow already. So it's quite a good sign we have. And also, I think if you recall, I think last year talks are actually on the ringgit, on the oil, but it's proven. I think the market has very short-term memory. When the market actually sentiment turns better, suddenly those are not the concern anymore. As you can see, I think on the later stage, ringgit still, I would say, appreciate somewhat despite the oil price start to decline. And of course, I think if you look at the CI, actually perform much stronger compared with last year. And you know, the last year always, I think they move in tandem. It means say oil lower, your ringgit lower, and your market lower. But that is not the case right now. So it looks like the sentiment start to strengthen somewhat. And of course, I think the Dow also show the same thing. You look at the Dow Jones Index and the black line here, keep on making new high, despite the dollar index actually start to decline. Volume also, I think the trading volume and the trading value, you saw a very strong spike off late. Also, if you want to look at the sentiment, probably you want to look at the small and mid cap. Even here, I think the FBM 70 and the FBM small cap index actually, in terms of total year-to-date total return, is definitely outperformed the CI in a quite of I would say the wide margin. Especially I think after February, you can see February suddenly things are actually turns. I would say slightly more aggressive. Also, I think the valuation also start to playing catch up. You can see this is the forward PER for the CI. It's actually stay quite steady, but I think for the FEM 70 index actually surpassed the CI, and even I think small cap index in terms of the forward PER also have been on the rising trend. So all those things I would say primarily we think that the market sentiment definitely have shifted to I would say the more bullish kind of scenario. In fact, last year we keep on talking about the resilient play. We want to look for dividend. But those stocks, if you look at say for instance the REIT stock, in terms of performance compared with our property index, compared to our small cap and to our mid cap index, definitely I think they are outperforming right now. So meaning to say the market actually start to shift away from the more defensive mode to slightly more aggressive now on. Definitely, I would say this is good news for the market. In terms of consensus target price also, I think last year we saw they started to I would say to make a turnaround, and now they continue to move up higher. Of course, I think the market also play a catch up quite fast. I think at one point they actually diverged. They mean to say the consensus start to revise up their target prices, but the CI actually go at the opposite direction. But now CI actually start to play catch up against the consensus. Now the problem right now is whether this consensus target can continue to be revised higher in order to make room for CI to play a catch up. So from all this observation, probably we can say the sentiment definitely is now better. I think market ready to take slightly more higher beta stocks compared with the defensive one. But really, if you look at the fundamentals, have they actually changed? The answer to this, definitely, we see not much of changes. If you look at the earnings side, yes, I think the recent results, when they actually came out, we saw some improvement. There are less disappointment in terms of result. But again, I think the growth going forward to us is still pretty flat to a slight negative. We are slightly more conservative compared with consensus. Consensus looking about 2% growth in terms of corporate earnings this year and 6.4 next year. We are flat to negative kind of growth. So probably we have some room for us to revise our numbers higher. But even with that, I think after the result also, I think my analysts don't really, I would say, increase or the revise their earnings forecast in a major way. So to us, it's still quite a pretty neutral kind of scenario for the earning. But all in, we still have to revise up our target price. I think now our target price for CI year-end is at 1775 from 1750 earlier. The target price actually pretty much in line with the consensus. Consensus looking at about 1780. That actually 1775 actually implies about close to 16. I think in between 16.5 to 17 times FI 17 or FI 18 kind of PE, which I would say that this PE is achievable because during strong sentiment, normally this PE can stretch up to 17 to 17.5. So at 16.5, I would say probably I think is not too stretched, and I think it's achievable. There are also some, I would say the concerns remains apart from the, as I said, I think the earnings still pretty neutral. The excess liquidity in the banking system, as you can see here, still remain at a low level. I think this is one of the concerns we have. Originally, this excess liquidity used to be our strongest argument for the market to be very sporty, because so long you have more liquidity in the banking system, that liquidity will actually potentially translate into the fund flow to the equity market. But now the excess liquidity, I would say, is pretty close to the historical low. That is close to the low post global financial crisis. And also, I think another, I would say, the caveat is that I think market now probably, I think yes, we have to admit it's pretty strong. I think sentiment has changed everything, but the upside from here at the same time, probably I think we have to reckon that the upside probably is getting limited if you compare with our target price and even consensus 1775 and 1780. Probably only about the 30-40 points index from here only. Actually, that actually also coincide with this study. If you look at this band, this is the discount between CI and consensus, and normally at the top or the higher end of the range, the market will normally be toppish, and we are fast approaching that level. Valuation premium over the regional market also have improved. I think last quarter used at the lower end of the range. I think the range normally is 4% premium to about 18% premium kind of fluctuation. Now we are actually maybe closer to the average really. So in order for the market to play catch up, is the foreign flow have to constantly to come in. Still have some rooms. Not saying that we don't have room for catch up, but it's just that the room compared with the previous quarter definitely is lower right now. And the hope for our dark horses, I think, recall last quarter we thought crude oil and crude palm oil, they did quite well. We thought that these two, the plantation sector and oil and gas sector, potentially will lead the index, but it turns out not as per our expectation. I think recently, oil prices start to come off, and also I think the same goes to CPO price as well. So these two make our the hope for plantation and oil and gas sector to become dark horse is getting lower at the moment. And I think recent run also, I think for the index, actually by banks, and why the banks actually suddenly it looks like they have back to the investors rather. One of the, I think the argument they make, I think, or the market start to realize that, I think for the European side, they will have quite a number of elections. I think in the next one quarter or maybe next few months, and that uncertainty actually make the money or the capital from the European actually flow back to this region. And also I think the European actually run into the negative interest rate. So for their banks, they always will see a negative net interest margin kind of scenario. That actually compared with the banks in the region, we still see a positive net interest margin. So in terms of profitability, in this part of the world, the banks definitely is more profitable than they are. So that's why the demand for banks in this region actually start to increase. And even following the 25 basis point hike in the Fed fund, but the US equity market still remains strong. That actually probably is a signal that the market actually anticipates US economy to strengthen further, because normally high interest rate will actually lead to a decline in equity market, but that wasn't the case for this round. Even when the hike, then the US Dow Jones actually move up even faster, about I think on the night about 200 odd points. So probably it's that kind of expectation market start to build in, and therefore I think they actually change the sentiment for the investment. And of course I think GE play for ourselves will still be there. I think this is one of the strongest argument we used previous quarter. We said that in terms of valuation, even though let's say the earning is not, I would say, the impressed, but it's still possible to see CI to trade at a higher PE. Just judging from the another indicator we use, that is the FBM KLCI market cap to GDP ratio. If you look at this ratio, before last year 2016, it used to actually fluctuate within 0.92, the lowest, to as high as 1.09, which is 1.1. And note that the 1.1 times ratio is during the year 2013. 1 year before and 1 year after that also close to 1. And last year we actually ended up at 0.9. This is one of the lowest point we have for the past 6-7 years. And that actually make us believe that probably I think the valuation is rock bottom, and we should actually see a rating soon, and that is probably I think the market start to react into it. And also I think we argue that even at that time, like I think 2015 and 2015 and also 13, you can see these 2 years in terms of earning also is negative, but their ratio also is not that bad. So it's definitely higher than what we have in 2016. And this is I would say the rationale for it probably is the expectation of GE and therefore market allows such a premium valuation. So to sum it up, I think we can safely say the recent upswing in the underlying market probably is more of sentiment driven or maybe liquidity driven. So if you believe this is the case, then our emphasis from now on is more on these two. So we have to monitor the market sentiment and market liquidity very closely. As I said, I think the fundamental is almost unchanged. So now it's only the sentiment and liquidity to drive the market. So long if these two so-called factors continue to play their role, then the market could potentially move higher. And will that be the case? Let's look at the sentiment. We try to quantify the market sentiment by using the discount between the FBM small cap index and also the FBM KLCI. Normally, in a nutshell, FBM small cap index in terms of PER, the valuation, they are always at the discount to CI. You have to admit this is a fact. And whenever the market actually turns more bullish, the discount will narrow. That means that people will start to buy into small cap and therefore chase up the valuation for the small cap, and the discount will get narrow. If you believe that is the case, then we can actually start to do some analysis. Now, normally, even though the discount will get narrow, but also there is still a limit. Normally, it will become toppish when it actually is less than 4 times discount, and we actually recently saw that for small cap index, and we cannot actually rule out potentially there is a potential that could be a correction from here. Also, I think if you look at the 70, FPN 70, normally they will become toppish when their discount actually surpass their band, and now look at that. As I said, I think now FPM 70, their internal index, in terms of forward PER valuation are much more expensive compared with CI. They are doing about 18, 19 times PE, whereas the CI only did about, I think, 16 to 17 times thereabout. So these two, probably to me, I think the sentiment probably is about a bit overheated at the moment. So probably we need some time for the sentiment to cool down. In terms of liquidity, I actually adopt these technical indicators called volume price trend. But actually I did some modification on that, and we try to use that to actually measure the buying or the selling interest in the market. Now, in a nutshell, what we did was we used an absolute change of in this case daily. You can use any period, then you just time the volume on the period, so the same period at the same time. So we use that product. We actually do a summation, and we can actually look at the trend. You can see this red line is actually the indicator. Normally we will turn a day or I think some days earlier compared with the CI, and it looks like that buying interest has been on the uptrend, and I think off late you can see actually the spike quite strong. Yes, I think so long if we didn't remain above the 30-day so-called moving average, it looks like it's still an uptrend. But again, of course, the surge was pretty strong. So again, we do not actually discount a short-term pullback from here. So the findings for these two definitely suggest the buying interests are there, sentiment still strong, it's just that maybe the upside getting limited, and I think probably it actually will suggest a potential pullback. So in terms of market timing, probably we need to maybe position for I would say for potential pullback. If you really buy into this idea, then by right at this level is our sell and strength zone. As I said, I think if you look at the discount between the CI and the consensus, anything between the +1 and the 2 standard deviation actually the topish zone. So normally they ended up with the corrections. So this will be our sell and strength. In fact, at this level, is still considered our sell and strength zone. And we hope that the pullback will actually end between, I think, the average and also -1 standard deviation level, which is about this level. So anything below 1705 to 1670 is our buy on weakness zone. So I hope we can actually accumulate or to position ourselves at this level. At the current level, definitely, probably I will stay sideline if you actually don't really keen to adjust out at the moment. But by right, at this level, it's our sell and strength, and I will to take profit for now. In terms of stock, as I said, I think fundamental remain pretty unchanged. Mostly, I think the market swing actually is driven by liquidity and also sentiment. So we need to still go back to the basics. I think we still look at those sectors we like. We still have overweight or the outperform calls. So far, I think we actually overweight on aviation, glove, parcel packaging, power utility, and I think recently we just upgraded property and technology. These two sectors. I think for aviation, with the decline in oil price, probably I think will benefit them. Within these sectors, we have Asian airport. Glove, I would say this is quite a steady sectors. I think at one point, I think we saw some sell down. That is because of more on the valuation. After the sell down, I think the valuation now is back to a more reasonable level. And also, I think the industry players are now getting more momentum because of the higher average selling price and also their margin expansion. So we probably will see the result to improve from now on. In fact, I think the top growth already shows our strength. That's why we pick top growth as our topic within the sector. Parcel packaging, I think, is one of the sectors that we like, and we actually be committed to this sector as well. I think we have been calling it overweight sector for some time, and I think it has not actually failed our expectation for that. A lot of people actually ask us why we actually like this sector. I think to us, this sector probably is really, I think the growth is driven by pure market demand. If you look at your recent days, I would say the product, you will notice, let's say for instance, your canned drinks, I think your Coca-Cola, all those, they're actually wrapped by plastic. No, they are not wrapped by, or they are not in a paper box or carton anymore. If you go to the construction site as well, if you look at the bricks, how they actually transport the bricks, they're actually wrapped by the stretch film, and then they just transport. So the more and more applications start using plastic packaging. And also, I think if you look at the e-commerce, most of the e-commerce now, the packaging also in terms of the packaging are mainly, I think, using the plastic as well. So the demand for this segment actually is getting stronger. And also, I think even the recent days, the government actually start to ban the polystyrene large boxes to a recyclable one. Also, I think that will actually benefit the player like the SCGM. They are one of the bigger players in this as well. SLP is also our favorite. I think they are actually mainly export to Japan. If you go to Daiso, you buy the standard plastic bag. They got S size, M size, L size, all those are standard. They call it the kitchen or the garbage pack. So those are their products. So and most of these players now they are also like early days of glove. Their margin actually expand by the technology know-how, because for the similar weight of raw material now, they can actually do maybe longer, or the usage when you can actually stretch it longer. Then it means the length cost actually lower. So this is how they actually manage to improve their margins. Power utility, I think, is a quite defensive one. I think PASET is a smaller cap, the only smaller cap we like. And also, I think, of course, I think Kenanga as well. But I think Kenanga for second half probably you'll see some weakness, because the ICPT, that means that the imbalance cost pass-through mechanism, they will probably need to pass more benefit back to the consumer. So we probably will see some dip in their earning, but that is not really a big concern to us. If you compare with previously, the Kenanga now is definitely in a better position, because with the pass-through mechanism, their earnings are getting more steady compared with the previous years. And also, I think in terms of valuation, they only do about, I think, 14-15 times PE compared with the CI, who have a much higher PE than them. So we still like Kenanga in this sense. And of course, I think the only pullback is, I think, the foreign shareholding in these stocks, I think, already gone up. So to bring this stock higher, probably you need more buying from here. That is the only pullback. Otherwise, I think from a fundamental point of view, we still like it. Property is more on tactical call. I think we just upgraded recently, mainly because, as I said, I think the market sentiment is better. So the market now, they start to go into higher beta stocks. They're willing to take some more risk. And as you know, I think the property is one of the definitely the sectors or the stocks actually come with the higher beta. And but I think for this sector, we try to go to those who have been lagging behind in terms of performance, like names like, I think, Prop. I think last year they have been bashed down because of the cash call. I think the cash flow already done. I think right issue already completed. So probably we will see a catch up soon if the sentiment continues to improve. Technology side, I think this is the recent upgrade, more on the fundamentals, because if you look at the 6-month semiconductor sales globally, it looks like actually it was actually exit expectations, and I think the consensus start to actually raise their estimate and forecast for that. And actually the sales actually mainly driven by, of course, still your IC and also your chips. And I think even automotive side, if you notice, I think recently more and more vehicle actually they use electronic items, and that actually benefits some of the players like, I think, MPI, even I think KESM industry as well. So that's why I think if you look at the share prices, they have been moving quite fast. In this space, we have PIE and Notion, because the other two actually, we still like it, but it's just that the recent price movement have been pretty strong. I think Notion also, the price have also moved up quite fast. But I think Notion, the in terms of positioning will be slightly different compared with others. That is more on precision manufacturing. I think why the share price has turned around so fast was because recall the last 2 years they have losses, derivative losses, because they ended in a contract, the hedging contract that actually against them, because the ringgit at the time keep on depreciating, but I think they take the opposite direction, and that's why I think every year they lost about 22 million for that, and that actually contract expired, and from now on they don't actually want them need to actually bear such a losses. That's why from now on you should see them to turn into a profit very fast, just without that derivative losses, and understand they start to have more expansion in terms of products, in terms of new clientele. So that will further boost their earning, and therefore we chosen as one of our topic for this round. PIE, as usual, I think they are positioning more on the potential iPhone 8. They are one of the, I think the parentage is from Hong Hai. I think definitely they will benefit from some of the definitely is one of the cost side. I think they will have advantage because they're using the global procurement via Hong Hai. So their margins are definitely better compared with the peers. And if you believe chip sales will still continue to grow, and with the two more, I think maybe two more new models are coming this year, then probably they are well positioned for that. Also, I think one of the strategy we promote this round probably is to just look at the laggards. As I say, I think the fundamentals remain pretty much unchanged, but it's also more on the sentiment and liquidity driven. So probably want to look at those who have been underperformed or lagging behind the rest, I think, in 2016. These are some of the outperformed calls. I think you can have a clear picture when we actually issue a strategy next week. In a nutshell, these are our outperformed calls, and we actually try to look at this part. I think the laggards, I mean to say the one who actually underperformed. If you look at our topics, mostly it will actually come from this range. The NIM, I think IOI, I think TM, Top Glove, SK Petrol, all those are from the laggards space. Of course, I think PIE, Notion, as I mentioned earlier, SLP, SCGM also is more plus packaging, as mentioned earlier. The only bank stocks, because we just now we said the interest from the banking industry have been catching up. Therefore, we pick Hong Leong as one of our topic. Why we pick Hong Leong is that I think my analysts still pretty conservative over the provisioning. I think for the FRS 9, which will be implemented in the year 2018, probably require banks to do more provision, and therefore will actually hit their numbers. So most of the banks under our coverage, they either have a flat or slight decline in profit in that sense. And I think only the few banks like I think Public, Hong Leong, maybe Alliance, because they have a slightly higher loan loss coverage ratio. So we actually believe probably the positioning for them could be lesser compared with the peers. And out of these three, I think in terms of valuation, in terms of their ROE parameter, all those things, we still think that Hong Leong give you a better valuation. So therefore, we pick Hong Leong as one of the topic for this round. And I think to sum it up before I end my presentation, just to emphasize again, we see that I think the fundamentals have not shown much changes this round. The market rally probably is more on sentiment and the liquidity driven. So therefore, I think the timing is very important to us. We always believe possible to try to buy into weakness, and if then to actually lower our risk. As I said, I think the buying on weakness zone will be 1705 to 1670. That will be the area we are more comfortable with. And we try to go for laggards, and we try to stick back to the fundamental. Those who actually give you the profit are those one we want to look at. Thank you very much. Yeah. And any questions from the floor? JCY actually is in different segment. As I said, I think we still have to look at their earning profile. As I said, I think the first round of turnaround for Notion was because they're actually into losses. Now they're actually back into profit. And at that time, I think Notion at 40 or so only, I think they're about 0.6 times book. And JCY, even that time, I think it's about 0.8 or 0.9 times book. So in terms of valuation, Notion are much cheaper compared with JCY. And now if you turn into profit, and also with the new product coming in, the PE, let's say at 1.6 something, that PE only, if I'm not mistaken, is about 15 times PE. But for JCY, the earning is much more volatile compared with the Notion because they're in HDD segment, in the hard disk segment. That segment I think is highly competitive, and also I think if you look at the earning for JCY, also mainly come from the forex translation gain. So if you take out the gain, that means the PE definitely is much higher compared with the Notion. So, and of course I think we don't cover JCY in this case. So yeah, so probably if you want to go for those laggard, I think yes, I think we can go for some laggard, but I think still we need to go back to some fundamentals.
Any more questions from the floor?
Yes, as I said, the earnings mainly come from the forex translation.
Mr. Chan, thank you for your presentation. Just get your view on two questions. First and foremost, with regards to the exporters of our country, with President Trump imposing the border tax of all imports into America, how will it affect our exporters? And with now the government's policy on retaining 75% of US dollar proceeds in Malaysia, how are these two factors affecting our exporters? That's my first question. The second question is that our market has been going up on a weaker ringgit. Similarly, the US market is also going up on a weaker dollar as well. Does that mean that the market is, or the currency is decoupling from the market, or something of an anomaly is happening to the market?
I think with regards to your first question, sir, I think border tax, I think the 75 so-called the percent, the proceed, all these things. In a nutshell, I think it wouldn't make too much of an impact to our exporter. Now, if you look at the border tax, actually, if it's for everybody, it means to say it's a fair playing ground. I mean, everybody will have the same problem. So if that's the case, I mean, everybody will need to pass down the cost of whatever. So basically, not much of difference. The only thing is, if let's say US want to promote certain industry in their countries domestically, it means that there's certain product they may actually impose a higher tax, and that sector probably will get it. Other than that, I would say it's the same. And if you look at the cost of production, whether it's feasible for them to produce, that's another question you need to assess. To us, I think the cost also not, I would say, not cheap in the US as well. So even though, let's say, you increase your tax, maybe their products maybe also is at a higher pricing as well. So probably we still have the advantage of that. The 75% definitely, I would say that I would say in a sense it's good for Notion, especially. That means if they have come in earlier, that they don't need to go into some hedging instrument, and probably we will see a profit for the last 2 years. I would guess this is more of a discipline for all those exporters. Of course, I think now probably some of them they will enjoy from some translation, but with this thing, of course, maybe if the trend actually in their favor, probably the translation gain is not as big as before. But we try not to actually emphasize too much on the forex translation, because to us export meaning more for the volume play, the volume growth for the bigger market. So we try to position for that, but it's not purely on the dollar play. In terms of your second question is on the decoupling, whether the currency. That's why I showed you this now. I think when things are getting more and more bullish, suddenly the market start to they forgot about all this bad experience. Suddenly, yes, those are all diverged. There are no relationship at all. But I think, in the long term, that probably will be normalized. I think it's more on the sentiment kind of things rather than I think the fundamental. I don't think they will actually decouple unless you have a different perception. I think for US case is that they actually believe the new president will drive their local economy, and therefore they don't really worry too much on the currency. But but for our case, by right, they still need. I mean, they still need a weaker currency in the US because most of their business is still overseas. Unless you're telling me they actually move their overseas business back to their own home ground, I mean the domestic side, and therefore then they don't need a weaker currency. So a lot of I would say the development recently is not follow the textbook. So yeah, I can only say probably the sentiment who actually make such a changes.
Mr. Chan, first question. As you said, the present performance of the market is more of sentiment or liquidity driven. How well sustained do you expect it to be? And number two is inflow of foreign funds into Malaysia, into emerging markets. Now, the inflow in Malaysia as compared to the other emerging markets like perhaps Indonesia, Philippines, Thailand, and so on, how do we stand the rates of inflows as compared to the other countries, the emerging countries? What do you think is it?
The first question, I think if you look at my slide, I think the title for my slide actually explains it more. I start with the trend is your friend, put a question marks there. That is exactly the thoughts we have. No, I think we can just be a trend follower. And now that's why I emphasize we have to monitor the indicators to look at the market sentiment and also liquidity. Once actually show concrete sign of reversal, then probably we need to react on it. Otherwise, we just have to ride the trend. I think that is the best we can do right now. If you look at the fundamentals, as I said, there's nothing changed. And if you look at the FBN 70 index, I think some of the stock actually perform very well, like name like I think Post, name like I think DLP Highcom. If you look at the earnings, you know what I meant. I haven't changed anything yet. So I guess that is the best we can do. For your second question is on the foreign fund. That actually information we don't really compound how much they flow into the region, but I read some of the foreign report. Malaysia, in terms of their portfolio, in terms of foreign portfolio, is still less than the MSCI rating. So therefore, they actually expect more foreign flow to come in. If I'm not mistaken, they talk about 9 billion more, if I'm not mistaken, to be potentially flow back to Malaysia to actually play a catch-up in terms of the rating to actually back to the MSCI, the allocated rating for Malaysia.
Last question.
What are the pros and cons of DRP? Dividend reinvestment plan, like Maybank, CRP. What are the pros and cons in this type of plan?
Pros and cons, actually, I would say probably is really cash or non-cash. I would say so. Actually, to us, the pros probably, I think, for the reinvestment plan in general, because they will give you some discount to the market, so probably the cost is better. That probably is the case. And then, yeah, the cons is between cash and non-cash. Yeah, but of course, I think once you receive it, you can just sell it. But of course, I think some retail investor actually they may complain because if you're having a very odd lot, it's not cost efficient for you to sell because you still have the commission for that. So yeah, that probably is the difference. It's okay, but so long if your company keep on growing, your EPS dilution will be minimal. Unless your company not making money, the share base keep on ballooning, yes, then your valuation will become higher. it's the same thing. Without this, also it's the same thing. I mean, if let's say the earnings, I mean, that's why I have to still go back to fundamentals. We still have to look at the earning growth. So long the earning growth is much faster compared with the so-called their growth in their share base, it's perfectly okay. Yeah. With your valuation will automatically have to adjust for that. Yeah. So when you actually look into the valuation theoretically. Yeah. Okay. Thank you very much.